Martin Yang, Oppenheimer and Company senior analyst of emerging technologies, joins us now. Has a buy in the stock, price target 195. It's a long way from the $3 million this company was worth prior to going public, I think, some time back. Can it keep going, I guess, is the question that everybody has. Martin, what do you think?
Yeah, I think it can. So when you compare Apple's earnings power and how that earnings power can grow consistently in the next, let's say, 3 to 5 years, I think this still remains a buy. The calculations that, you're factoring price increase, buyback, and new products, services, high operating leverage coming from high margin service revenues, I can pretty easy to come up with maybe a very sustained 15 to 20% earnings growth in the longer term. I think that justifies a buy.
All right. Well, your price target, though, is right around here. So are you going to have to adjust that to account for what you just told us?
We can't disclose any further changes on our price target, but I'm very confident that Apple remains a buy.
Service revenues, of course, have been an important component of the higher multiple that the stock has received. And when we are talking getting up in the high 20s, almost 30, does that give you any pause?
No, I think service revenues will see a revival. In the past 2 years, service revenues will see some challenges coming from both macro factors as well as Apple's own self-inflicted wounds coming from the IDFA. But Apple is expanding very aggressively on in-house services, payments, music, multimedia services. Those can more than offset the headwinds they have inflicted on the Apple App Store.
So, Martin, what's the risk? Is it macroeconomic that they just don't sell as many iPhones in places like China?
I think in the near term, you will see definitely risks on iPhone slowing down, but we haven't seen that yet. iPhone still outperform Android markets very significantly on a year-over-year basis year to date. I think maybe the risk for investor expectations that you will see a slower growth on emerging markets like India, like other, Southeast Asia, Middle Eastern countries who have delivered very, very strong year-over-year performance. And if we see, sooner than expected slowdown in those emerging markets, that would change the long-term iPhone growth and install-based outlook.
And finally, the Vision Pro, I'm just curious. I mean, they introduced the watch. It took quite a while, but now it's got a pretty decent revenue number. Do you have expectations that over time this could become a product that really means something to Apple?
Maybe it will take longer than the watch because I think it's a very, very challenging form factor. Not everyone is used to dealing with 200-300 grams on your head and then keep that device on your head for more than 30 minutes. Watch is a very natural fit on your wrist, and most average consumers are very used to the form factor. So Apple is dealing with multiple challenges in addition to a very high price. I think it will take much longer than the watch.
It's been remarkable, Martin, to watch them be so disciplined on two things. One is sort of second strike advantage. Watch is a great example. And then sort of discipline and growing organically. Is there any reason to think that their M&A strategy would go bigger in the next, say, 3 to 5 years?
I don't think so. Because right now, they are not seriously challenged in the key markets they're in. All the hardware are gaining share. If anything, I think the share gain will accelerate in a tougher market. And on the software services side, platform remains very stable, still the go-to app distribution platforms, and they're expanding services, gaining share on music and media and payments. So I don't think it's imperative for Apple to do large deals. There's no compelling reason for it.